those Main Street indicators and those Wall Street indicators suggest that we are clearly in a recession, and based just on the M2 money supply, either in it or heading towards one in 2024, and that has nothing to do with risk asset markets. Those are very separate things. And again, that's why I'm no fun at a party, because we hang out with people that are, in the risk asset markets. But also keep in mind that 90% of the wealth of the S&P belongs to the top 10% of the US population, of which I'm a member. So I'm not saying this as an apologist. Those who can afford to take those risks, and can afford to take those exposures, and can wait out those kind of Fed-driven markets, that's all they are. Markets go up or down where the Fed is hawkish or dovish, but the real America is in a recession.
The Federal Reserve's move to increase interest rates hasn't yet pushed the US economy into a downturn. However, RBC Global Asset Management places a 70% probability on a recession occurring in 2024. Matthew Piepenburg, a partner at Matterhorn Asset Management, argues that regardless of the Federal Reserve's actions, there are no positive outcomes in sight for the US economy. According to Piepenburg, the US is currently entrenched in a recession, dismissing the idea of a gentle economic slowdown as unrealistic. Despite recent signs of economic resilience, more investors are leaning towards a soft landing narrative. This scenario envisions the Federal Reserve successfully managing inflation without triggering a recession. This growing confidence contributed to significant gains in the three major US financial indices in 2023. The Dow Jones Industrial Average surged 133%, setting a new all-time high. The S&P 500 rose 23%, and the Nasdaq Composite, known for its technology focus, increased by 42%. However, analysts at JP Morgan Chase and Deutsche Bank, among other financial institutions, still view a recession as a distinct possibility within the next 12 to 18 months. Piepenburg remains optimistic about the S&P, Dow, and Nasdaq, but sees this optimism as separate from a flourishing economy. He holds firm in his belief of an impending rough economic downturn, supported by evidence, even if others disagree. Last year, 85% of economists in a poll predicted a recession for the current year, and that was considered optimistic compared to a 100% recession forecast 2 months earlier. To delve deeper into Piepenburg's perspective, the video provides a thorough examination. Before diving in, viewers are encouraged to subscribe to the channel and hit the bell icon for the latest content updates.
The S&P, the Dow, and the Nasdaq are Pavlovian. It has nothing to do with free cash flow, balance sheets, financial statements, real value. It has to do with whether the Fed is hawkish or dovish. And now the 2023 markets were, this carrot was always in front of them, that there was going to be either a rate cut or a pivot of some case. And so that kind of created this narrative to keep everyone expecting a pivot of some kind or a rate cut of some time. So the markets just followed that carrot on words replacing bad math. And there are very strong bull cases to be made, even myself, in favor of a rising S&P, Dow, and Nasdaq. That does not mean I think the economy is safe. And there's a massive difference between the economy and the markets. And we'll talk about the markets more. But in terms of the recession and this debate about a hard landing or a soft landing, or lagging indicators like bogus employment numbers from the BLS or debt-driven GDP, I think let's just stick to the simple stupid, because I think the stupid is really simple. To me, and again, this is my opinion, but the evidence supports it. The idea of a soft landing or no landing is, to me, farcical, when the evidence is that, the fuselage is on fire, the luggage is over the runway, and the engine's somewhere in the grass behind the plane, and the passengers are screaming. The evidence of a hard landing is pretty obvious to me, despite the be calm, carry on narrative. It isn't me talking my book. I look at basic Wall Street indicators like the yield curve. I mean, you still have an inverted yield curve that has symbols. That's starting to straighten. That's actually a negative sign, but the yield curve inversion is a clear indicator of a recession. The most obvious is the Conference Board of Leading Indicators, which has been right consistently, and that put us at a 4% threshold into recession last December. You've got M2 money supply at a 4% decline. There's only been 4 times in the history of our country where we've seen a decline in the M2 money supply. I mean, granted, it was up 27% between 2020 and 21, and only 4% down this year. But that's the scope and pace of that decline. The fact that there is a decline always indicates deflation, always indicates a recession, or even a depression, as we saw in the 30s. So those are basic, consistent, and reliable recession indicators, notwithstanding a completely Fed-driven S&P, which is not really free market capitalism, it's Pavlovian, as I've said.
Piepenburg underscores the potential necessity for the Federal Reserve, Fed, to implement cuts as a means to rescue the system. However, He warns that such a move might come at the expense of destabilizing the currency. The US national debt has skyrocketed to a record $33.9 trillion, marking a concerning economic development. This substantial debt is a result of persistent spending shortfalls compared to revenue, exacerbated by recent emergencies and economic challenges. Moreover, the high debt-to-GDP ratio attracts global scrutiny, raising questions about the sustainability of US fiscal policies. Piepenburg emphasizes that the repercussions of this massive debt extend far and wide, influencing currencies, bonds, interest rates, geopolitics, cryptocurrencies, and risky assets. Meanwhile, Jerome Powell, the US Federal Reserve Chair, expressed concerns in March about the potential job losses associated with bringing down the inflation rate, drawing upon the insights of his capable staff. According to Piepenburg, the influence of the Federal Reserve has not only distorted but also corrupted the true nature of the market. To delve deeper into these perspectives, attention is redirected to a video suggesting a more in-depth exploration of the subject.
To me, though, despite the fact that it's a mug's game to try and predict market direction, it's not a mug's game to see very clear patterns in debt markets. And I'm not talking 30 years out, I'm talking the next 3 or 2 years or even 1 year out. There's a ripple effect from debt, and those patterns are very clear because debt affects everything we're going to talk about. It affects the currency, it affects the bond market, it affects the rate market, it affects geopolitics, it affects crypto, it affects risk assets. The market arcs of the debt circle are critical. If you don't understand these different arcs, like recession indicators, bond market indicators, risk asset indicators, and then you won't understand the debt circle. And if you don't understand the debt circle, you won't understand the behavior of those arcs. So they're all interrelated. In terms of debt, again, boring at a Christmas party, a real downer when you're sitting next to bulls. For me, I'm happy because I'm looking only at precious metals, which wins either way. But I respect that many of your listeners are speculators, are in the markets and have risk and have questions about this. I think it ultimately does affect the stock market. But looking at very inconvenient, stubborn facts that to me aren't just something you can gloss over, even when a market's ripping, because they're very important beyond just the headlines today. You've got 120% debt to GDP. You've got an 8% deficit to GDP in the US, which will go much higher when we are officially in a recession. By the way, when you're officially in a recession, when the MBA tells you you're in a recession, you've already been in a recession. That's like a doctor telling you you're sick when you're already at the funeral home. But anyway, when you get into a recession, that deficit to GDP number gets even higher. You've got a net negative 65% net international investment position in the US. That means there's no piggy bank of assets outside the US for the United States. Congressional Budget Office just announced $20 trillion in more IOUs to be issued in the next 10 years. Again, that's assuming no recession baked in, so the number's gonna be much higher than that. We've got $100 trillion total debt in the US with household, public debt, and corporate debt. We've got twin deficits, and we've got a Fitch downgrade on our bond. And that's basically saying that, Microsoft and Johnson & Johnson have a lower risk of default in the US Treasury. The US Treasury won't default. But I'm saying these are massive, massive facts. You can't just gloss over. They're the worst macros I've ever seen in terms of debt, which is why we're seeing such a cornered and desperate Fed and the notion that markets are resilient. Remember, resilient markets, 2023 was on the promise of a rate cut, which we're now getting telegraphed for 2024. But in 2022, just a year ago, we had the worst stock and bond nominal performance in the history of our country since 1871. That's been forgotten. The gains now are making up for those losses, and they could go higher. But it's a short memory. At the beginning of this year, we had a regional bank crisis. We had 3 sigma moves on the short end of the yield curve in the T-bills, which, according to PhDs at MIT, those sigma moves should happen once every 50 million years. You could not get a bid or an ask in the bills, in the T-bills. So there's been so much disruption, and yet we're called a resilient economy or resilient market because what? The S&P, the Dow, and the NASDAQ are ripping on Powell's promise of rate cuts in next year's markets. That's how desperate the markets are for a good narrative. But again, and that is the reality, markets are Pavlovian. They will rise on a dovish Fed or a promised dovish Fed because today, a market is really based on dovish or hawkish central bank policy because the Fed is the market. That is a complete distortion and corruption.
Despite easing inflation, low unemployment rates, and major stock market indexes reaching record peaks, a significant warning looms in the form of the record-breaking US national debt. This serves as a crucial alert for policymakers and citizens alike. Initially, Expectations were aligned for a looming recession in 2023. However, as the year concludes, the anticipated economic decline has yet to materialize. As attention turns towards 2024, uncertainties arise. The question of what lies ahead prompts an invitation for valuable input from viewers. The audience is encouraged to share their thoughts in the comments section. If the content has been helpful, a thumbs up is appreciated, and viewers are reminded to subscribe for staying updated. Gratitude is expressed for the audience's participation in this journey.